So how is depreciation calculated? So you have to determine the basis of the property. Basis is just a tax term. I'll break it down on the next slide, but you determine the basis of the property, then you separate the cost of the land and the building. So you can never depreciate land, only the structure. So remember that. And then, after you separate the cost of the land from the building, what's left over is your basis in the property. So when it comes down to taxes, you're going to want to know what your basis is. And I'll explain that right now. So basis is the cost or the amount you pay to acquire the property. It can include some settlement fees, closing costs, legal fees, recording fees, a bunch of fees, basically like your closing costs. So whenever you're trying to figure out the basis in the property, I would get with your accountant to do it. But essentially what they're going to need is your settlement statement. So they'll see the purchase price plus the fees you paid to help you determine what your basis is in the property. And that number will change every year. So let me show you how it works. So here's how it's calculated. We're just going to use an example of just a $200,000 residential purchase. So you purchased a property for $200,000, you had $5,000 in closing costs, so you're all in at $205,000. So remember, that's the original basis. So then you have to take out the cost of the land. So the value of the land. So if the land in this case is worth $30,000, you take that out and you're left with $175,000. So that's your original basis in the property, or that's your basis in the property, $175,000. So then what you do is divide it by 27.5 years because it's residential. And the number you get is the amount of depreciation you get to claim every year. So in this case, we got 63.64 each year. What does that mean? That means that $6,364 of income that you receive from the property is tax-free. You don't have to pay taxes on that amount. So let's say, for instance, I made $7,000 in cash flow from the property for that year. Well, I would only have to pay taxes on whatever the difference is. What, $636? Whatever that, 7,000 minus 63.64 is what you're paying taxes on. That's how depreciation works. It allows you to not pay taxes on the amount that you're depreciating. So let me break it down even further. So in that same example, remember I was saying you have to track your basis. And this is done on your actual tax return. Each year, your accountant should be keeping up to date with this on a specific form in your tax return. But each year, you're going to deduct that $63.64 that you're not paying taxes on. So in this case, we started with the $175, which our original basis was at the purchase. And then each year here, you just see all I'm doing here is just deducting $63.64. It's important because the IRS wants, they're going to want their money. So I'm telling you that you don't have to pay taxes right now on it. But if you decided to ever sell, this is how they determine your capital gain. So let's say after year 10, properties went up, property values went up. You bought it for $175, it's now worth $250. So you want to sell it. But remember, we then took $63,640 of depreciation over those 10 years. All that is the $63.64 times 10. So that $63,000 is what we did not pay taxes on at all during that 10-year period. So the IRS, they're going to want, it's something called depreciation recapture. So essentially what it's doing is when you go to sell this property, they're going to take whatever you sold it at minus whatever your basis is at the time. That's why this is being tracked on your tax returns every single year. Your accountant should be updating this amount every year. So instead of you thinking that you would only have to pay taxes on $250 minus the original $175, and that would have been a $75,000 gain, you actually paying taxes on $138 because you never paid taxes during those 10 years on this amount. So they want to recapture that depreciation. So keep that in mind. That's important to know, rental owners, you know what I mean? Like to make sure you're not getting a bigger tax bill than you think you are. So just make sure whoever's doing your accountant, whoever's doing your tax returns, is making sure they're tracking this basis because this is important. You absolutely need this. And if you own properties already and you have not depreciated the property, it's not too late, but you definitely need to get that fixed right away. And also a question I know y'all gonna ask me at the end is, what if I own a duplex or a multifamily property? So if you do, you still can depreciate it. You just cannot depreciate the part you live in. So that's where you would need the accountant or CPA, somebody to help you figure out that what the taxable amount is. So essentially the part you live in you cannot depreciate, but the part, you rent can be. And it gets a little complicated. So make sure you